Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be learning about how double entry bookkeeping system is an important aspect of accountancy. We'll understand what are the types of double entry bookkeeping system, what are the advantages, and how a traditional and conventional approach has a difference when it comes to double entry bookkeeping system. Let's go ahead and find that out. So, when you know about double entry bookkeeping system, it is a system which has a lot of dual aspects. Now, when we talk about dual aspects, it is more concerned on how a specific system has been used when it comes to recording transactions. So as you know, we have 7-step process that we have already learned when it comes to accountancy. The 7 most important steps which leads or probably leads to a specific end or closure of any accounting system. Right from the start to the end of it, it is an end-to-end process which has been divided or classified into 7 steps. We'll further reiterate these steps for you so that you can understand and have a link of it when it comes to double entry bookkeeping system, which we'll study further in this subject or in this video. Let's go ahead and find out what are these things or what are these 7-step process. I've mentioned down certain jotted points or probably some short codes for you so that you'll be able to understand how these specific systems can be used or are classified when it comes to usage of double entry bookkeeping system. Let's go ahead and find out each one of them one by one. So the first one itself says identification of a financial transaction. As you know that when it comes to accountancy, we always keen or probably look after all the financial transactions and all the non-financial transactions are skipped out. Hence, when we talk about mentioning any kind of transaction, it has to be identified as a financial transaction. That's the first process that we need to talk about, or that the first step that when we talk about accountancy or when we go forward with accountancy, this is the first step. Now, once you've identified the transaction, what is the next step? Correct. That will be measurement. Measurement of all these financial transactions in terms of monetary value. That is the second step when we talk about any kind of accountancy process. So once first you have identified the transaction, the second step will be to measure that specific financial transaction in terms of monetary value. Once this measurement has been done, we further go ahead and record these transactions. So the third step will be recording this specific transaction. Let's go and find out more about it. Now, when you record these transactions, you have different books of accounts where you can record all these transactions which have been measured into monetary value. Now, you have journal, you have trial balance, you have ledger balances where you can record all these transactions. However, if we go step by step, you have to first record each and every entry or each and every transaction in a journal, which then is carried forward to a ledger and which helps or facilitates in preparation of trial balance. So the step process will follow as which we have explained right now: journal, ledger, and then trial balance. And after trial balance, we'll further go ahead with preparation of profit and loss account and further preparation of balance sheet, which will be the closure of accountancy or any kind of bookkeeping system that we have. Now, once you have recorded these transactions, the next step will be classifying or summarizing. Hence, the next step after recording is summarizing these transactions. Summarizing these transactions means any transaction which has been posted in a journal, then you classify or summarize them under different categories. Like all the transaction which has purchase aspect will be a part of purchase category. All the transaction which has sales aspect will be a part of sales category. All the transactions which has expenses and income category or income aspect, that will be a part of expense category or income category as per the nature of the transaction. Once that has been done, you then further go ahead and put forward all these details in preparation of trial balance, which then goes towards a specific person who is a chartered accountant of a representative firm, and this guy further does any analysis and interpretation that he feels or the firm feels deemed according to that. And once that is done, this specific chartered accountant will go ahead and publish these details. But before that, there's certain analysis and interpretation that needs to be done. Let's find that out. Before you analyze and interpret, there is something known as classifying, which is again a part of recording the transaction itself. So once the transaction has been recorded, it can be either summarized or it can be either classified. Hence, we have marked both of them as together. So when we talk about summarizing, classifying, after this thing comes analyzing and interpretation. Here, the chartered accountant goes ahead and analyzes all the transaction details which have been mentioned in the trial balance and the further profit and loss account and balance sheet, which then is supposed to be communicated to the users. Hence, the next step after this will be followed as communication to the users. So when we talk about communication to users, that means the audited or probably the true and fair financial statements are shared to the external users, who will be the investors, the shareholders, the lenders, the suppliers, etc. And the same information has been passed on to internal users, which may be the managing directors, the VP, the board of directors, who further go ahead and enhance the policy of any company as per their requirement, or further go ahead and put forward new policies which are in the benefit of the company's organization or the company's formation itself. Hence, once these steps are processed or these steps are followed, we further go ahead with how all these transactions are a part of double entry bookkeeping system. Let's go ahead and understand what double entry bookkeeping system is actually and how it forms, or it is an important or core aspect when it comes to accountancy. Let's go ahead and let's do the next sheet and find out what are the details that are mentioned here. So when we talk about dual aspect, we are actually talking about double entry bookkeeping system. This system deals with dual aspect. That means two or more accounts are actually included when each transaction is concerned. The minimum value that needs to be concerned or which has to be a part of any transaction should be 2. Or more will be absolutely fine. However, 2 is the base minimum that is required. When we talk about dual aspect, that means each transaction will have two effects for two accounts rather. When it comes to any transaction, if it has just one account, that cannot be called as double entry bookkeeping system. It has a different name named as single entry bookkeeping system. However, when we talk about double entry bookkeeping system, it has two or more accounts which has similar effects of that specific transaction. Let's go ahead and find out more details of double entry bookkeeping system here. Let's take an example. We have mentioned borrowing money from bank. That's an example, that's a transaction that has been given. Here there are two accounts that will be affected. The first will be the amount from whom the account or the cash has been borrowed. That means a bank. And the second thing is the inflow of cash. Now that the amount has been borrowed, there is an inflow or probably an increase in the asset side. So asset account is one that will be affected, that will have an increase in it. Similarly, on the other side, we have liability side, which is also increasing, because as it is a loan that you have taken from a bank, you're supposed to pay that back. Hence, it is a liability, and that's the reason any asset side or probably this specific transaction shows two effects, where the asset side is also increasing and so does the liability side. Once you pay off this loan, this liability will also decrease, and so as the asset side will also decrease when it comes to the cash balance, because you'll be paying off from your own bank account. Hence, when we talk about double entry system, this is the right example which we need to set when it comes to explaining what all details we require when it terms about or when we talk about any double entry bookkeeping system. So it has two effects. For this example, asset side increases because there is an inflow of cash. On the similar side, liability side also increases because you have taken a loan and you have to pay that back. So this is how you understand, or this is how the example gives you a lot of details about double entry bookkeeping system. Let's go ahead and understand few more points about it. Now, when we talk about double entry bookkeeping system, it has two aspects. One, that is a debit item. Second, that is a credit item. So, left hand side, or probably any account which has left and right hand side, that means a T account basically that we are talking about. The left hand side will show the debit entries and the right hand side will show the credit entries for you. Hence, any account, when we talk about a T account, we are basically talking about dual entry system itself. So the debit side will be always on the left hand side and the credit side will be always on the right hand side. So that is the T account formation, and that's how journal entries are passed or probably the ledger balances are filled. Now, the two more advantages of keeping this kind of double entry bookkeeping system with us is, first, it is accurate to the core. That means every debit should have equal and opposite credit. So there is less chances of any lawful, or probably we can talk about flaws in these transactions or in these books of accounts, because if you don't tally debit and credit, that means there are certain flaws. However, if you have actually maintained a book which shows the total of debit side and the total of credit side for you, then in such cases all these transactions will be tallied and hence it is accurate. On the other part, it also lowers down the errors which may or may not happen in terms of any other conventional book of accounts or bookkeeping system. Hence, when we talk about double entry bookkeeping system, the two more important things are, first, that is it is accurate, and the second thing, that it lowers any kind of errors that may happen in any other bookkeeping system. Let's find out few more details on what kinds of double entry bookkeeping system or what approaches we can follow when we talk about this specific accounting system. So when we talk about types of accounts, what are the classifications that we have when it comes to types of accounts in this specific category? Let's go ahead further and find out these details when it comes to accounting. Now, when we talk about accountancy, we have 7 kinds of accounts that we have mentioned here. Each and every account has its own specification, own examples, and they form an integral part of double entry bookkeeping system when we have to record these transactions under these categories. So these are not just mere accounts, these are basic categories, and under them will fall different kind of accounts which will be categorized as per the nature of the transaction. Let's understand each and every category of these accounts to further evaluate what all kind of accounts will be falling under these 7 categories. Let's go ahead one by one. We have first as assets. Now, assets are nothing but the property of the company. Something that a company owns is known as assets. We have different kind of assets here. We have tangible, we have intangible assets. When we talk about tangible assets are something that you can touch, you can feel, and intangible assets are something which you cannot touch, which are actually in terms of not valid, or probably when we talk about, these are the kind of assets which you cannot feel, which you cannot see, but they are still owned by the company. For example, when it comes to tangible, the car that the company owns, the building that the company owns, or any kind of property that the company owns which you can feel, the furniture that the company owns, are all tangible asset. However, intangible asset will be goodwill, copyright, patent, traits, trademarks. These are certain things that are intangible, which you cannot see, which you cannot feel. However, they still belong to the company. So these are the 2 kind of assets. Now let's go ahead and further analyze which are the other kind of categories that we have. Liability. Now, as you know, asset is something that a company owns. Liability is something that a company owes to someone. OWES. Mind the word. OWN is own. OWES is something that a company is supposed to pay to someone else. Hence, any specific liability or any specific transaction where the company is supposed to pay a specific amount to some lender, some supplier, in such categories, these accounts are classified as a part of liabilities. Supposing if a company takes loan from any bank, that forms a liability. It also forms an asset because there is an inflow of cash. However, it also forms a liability. Hence, this specific liability will be a part of any kind of liability account. Let's go ahead further and understand which other categories do we have for our discussion. Equity. Now, when we talk about equity, the second name for equity is capital. Now, when we talk about capital, capital is something that a company owns, or probably when we talk about any capital, a person who is handling a business of his own and is putting money in his own business in termed as capital. Now, this specific capital has a reason. It can be either for funding his own business, it can be either to maintain such things inside the liability part, so that in case of any kind of reserves or in case of any kind of exigency in near future, these transactions or these specific reserves or capital can be used for the usage of the company. Hence, this amount which a businessman puts out of his own pocket into the business is known as capital or equity. Now, there are certain different accounts like equity capital, preferential capital, any kind of shareholders investment is also formed as a part of capital. In fact, the reserves, the surplus, the profit and loss, the balance in profit and loss rather, is also a part of capital category itself. So if you see the balance sheet, you will have capital as a category and different account mentioned under it. So all these parts or all these things, all these accounts are forming a part of capital category. Let's understand which other categories do we have. Gains. Now, gains is something that a company earns whereby any specific transaction which is non-business or non-financial, or rather we call it as non-business transaction itself, like sale of an asset. However, the actual business of the company is selling out garments. If the selling out garments is a main priority business or the primary business, and if the asset that was used for preparation of these garments has been sold out and there is a profit on that specific asset, that means that specific amount or that specific income is termed as gain. However, there are different categories under gains. It can be a short-term gain, it can be a long-term gain. Short-term gain is basically which is a small amount, or probably we can term it as amount which has been used for, or probably an amount that has been earned on assets which have been used less than 12 months. Anything more than 12 months will be a long-term gain. Hence, when we talk about short-term and long-term gain, that is a part of taxable permit or taxable purview. However, we don't want to go into that further now. We'll just understand the overall category gains and the amount that has been credited or debited into this account. Now, debited won't be a part of this as it is an income over and above the expenses. Hence, it is termed as a gain. So, there is no debit entry here. It will be all credit entry that you need to mention in this part. Let's go ahead further and understand which are the categories that we have for our references. If gains is something that is over and above the expenses, loss is something which is less than the income. That means if gains equals to income minus expense, loss will be expense minus income. So if expenses are more than our income, we suffer loss. All the profit and loss transactions whereby any transaction that creates or further inculcates a lot of losses, that means expenses are higher and incomes are low in that specific transaction. Or else if the sale transaction where the cost of the asset was 10 lakhs and it has been sold for 9 lakhs, hence there is a loss of 1 lakh. Now, the market value of 10 lakh and the sale value of 9 lakh, there is a difference of 1 lakh, which clearly states that the asset has been sold at a loss. All these transactions, all these accounts will form a part of loss accounts or loss category. Let's further understand which are the other two categories that we have for our reference. Expenses. Now, expenses are something that a company puts down or probably maintains or goes forward with these expenses for the production to run through or the specific operating activities to go through every now and then. There are certain expenses that a company has to make. So these are all the transactions where if a company is making any transaction when it comes to keeping the production going, or probably any transaction which a company has probably filed in or went ahead so that to increase the capacity of the production or to increase anything, these kind of transactions will be a part of expenses. The next part that we have to understand is revenue. So when we talk about revenue, revenue is nothing but the operating activities due to which we earn our basic income, that is known as revenue. There's a lot of difference between gain and revenue. Revenue is due to operating activities, gain is due to non-operating activities. So if the problem states that there is a sale of asset and if the problem also states that there is a sale of goods, so sale of goods will be a part of revenue category. However, sale of asset depends whether there is a profit that is earned or loss that is earned will either form a part of gain or losses. So these are the type of accounts that we will be dealing when we talk about double entry bookkeeping system. To reiterate further, we'll go ahead with each and every topic again. However, these topics are something that you need to understand by core because these are certain things and these are the most prominent topics that will come in your questions, in your word problems, and these are something which you have to go through every now and then. So we'll go ahead with each and every one once again. Assets, something that the company owns. Liability, something that the company owes to someone else. equity or capital, where the amount has been put into the business from the owner's own pocket. Gains, all non-operational incomes. Losses, any operational or non-operational loss that you have to figure out, or probably the loss due to which there is a loss of expenses over income, comes under or falls under this specific category. Expenses, all operational expenses that a company makes to ensure that the production or the company's cash flow is going on and the production of the company doesn't come to a halt. Revenue, all operational incomes that you earn, is something that you have to mention under this specific category. So these are the type of accounts. Let's further understand what are the different categories when it comes to, or the different approaches when it comes to double entry bookkeeping system. Traditional approach. Now, when we talk about traditional approach, there are two kinds of approach basically. One is a modern approach, second is a traditional approach. So when we talk about traditional approach, it is an age-old approach that used to be followed. The other name for traditional approach is a conventional approach. Now, as you know that this is an age-old approach, we don't follow that anymore. However, it was an important part of accountancy. Hence, this is still in the question, like which is the best or beneficiary approach when it comes to double entry bookkeeping system. Now, when we talk about traditional approach, we have mentioned certain points here. Let's go through each of them to understand or have more clarity on this kind of approach. It's an age-old approach, as it has been mentioned here, and it has been classified into two accounts or two kinds of categories. First is a personal category or personal accounts. Second is impersonal account. Now, each personal and impersonal account have different kind of classification. We'll first go further with personal account classification. Now, personal account are accounts of human beings, someone who acts like human beings, or someone who is a representative of a human being. These three classifications have been mentioned. Impersonal accounts are basically two kinds, that is real and nominal accounts. So when you talk about classifications of traditional approach, you have two classifications, one being personal, second being impersonal. Personal accounts will have three further classifications. One, for humans. Second, who act or are like humans. Third, who are representative. We can call them as a mixture of both natural and artificial. So, naturals, artificial, and representative. These are the two kinds of, or probably three kinds of categories that you have when it comes to personal approach or personal accounts. Now, when we talk about impersonal accounts, we'll have two further. One, real, and second, nominal. Let's learn in detail how each classification has an importance, and certain examples will be mentioned there. Now, as I've highlighted certain transactions here or certain points here, personal account has three categories: natural, artificial, and representative. Natural, that means they are humans account. Second, artificial, that means they are like humans account. Third, representative, that means they belong to humans. That's why all these three classifications have humans in common. However, one is a core human account, second is somewhere related to account of humans, third acts or is like a human account. We'll further understand how each category can be classified into different examples. Let's go ahead with that. Now, the first classification that we have to understand is humans. We have debtors, we have creditors, we have proprietors capital, proprietors drawing, etc. Now, all these accounts belong to a specific human. That's why these accounts are coming or probably a part of personal accounts under the classification of humans or natural account. Hence, when a specific account is directly related to that user of that account itself, that means that is a natural account or an account related to that specific human itself. Let's understand the different categories we have under humans now. Like humans. Now, when we talk about like humans, they act or they behave like humans. However, not necessarily they are humans, they are artificial accounts. For example, we have Hindu undivided family, we have partnership firms, we have bank. Although under the law purview, we have all these things, they have a different entity. They have a different identity altogether. They are not humans. However, they act like humans. Hence, we have mentioned like humans as the category here. So, partnership firms, any proprietor account or any proprietor firm account, when we talk about any specific kind of Hindu undivided family, etc., all these accounts form a part of like human or artificial accounts. let's go ahead further and understand what kind of real accounts do we have. Now let's talk about representative accounts that we have. Now representative account is nothing but a mixture of both these transactions. That means human accounts and like human accounts. So we have mentioned certain examples. Let's go ahead and understand each and every example that we have here. Wages account, prepaid account, accrued interest. Now all these things are payable to one specific person. That means wages is paid to a person, accrued interest is collected for a person. Now expenses or prepaid rent, like these are something that are payable to one specific person. Although these specific accounts are not directly related to that person or not related to that specific person itself. However, these amounts are supposed to be paid to any specific person, hence they are representative accounts. So when we talk about representative accounts, they have both the mixtures of humans as well as like humans. So when we talk about personal accounts, we'll have three classifications here. First, the human account, that means the natural account, which belongs exactly to that specific person. Next will be artificial account, which will act like humans. That means partnership firms, proprietor firms, Hindu underwedded family, etc. Third will be a representative account, which will be again a part of personal account, but it is a mixture of both humans and any kind of artificial account that we have. For example, wages outstanding, prepaid rent, accrued interest, all these things which are payable to one specific person and are mentioned in specific accounts. That's why it is called as a representative. It represents a specific human. The word itself suggests it. Now, when we are done speaking about personal accounts, we'll further go ahead with impersonal account. We have two classifications under impersonal accounts, first being real account and the second being any kind of nominal account. Now we'll understand what real account is first and then we'll go ahead with nominal account. Let's go on to the next sheet and understand what all details we have here. Now when we talk about real account, these accounts are all related to assets and liabilities. Any assets, any liabilities that we have will fall under the category of real account. Assets and liabilities will be of two kinds. Assets basically will be of tangible assets and intangible assets. We have discussed this earlier. Tangible, that you can feel it, intangible, that you cannot feel or touch. Liabilities, short-term liabilities, long-term liabilities, short-term which are payable less than 12 months, long-term which are payable more than 12 months. Now all these kind of accounts or all these categories will come under the part of impersonal account under real account itself. Next, we'll have nominal accounts. Nominal accounts are basically related to expenses, losses, incomes and gains. Any transaction which shows this characteristic, that means any expense transaction, any loss transaction, any income, any gain transaction will be a part of nominal account. So to give you a brief gist of all these things, personal and impersonal, which is a part of traditional approach, under personal will have a specific category, that means natural, artificial, representative. Under impersonal we have real accounts and nominal accounts. Real will have two categories further, that means assets and liabilities, and assets will have another liability or and assets will have further classification of tangible and intangible assets, and nominal accounts have different kind of categories which are like expenses, income, loss and gains. So this is the traditional approach that we follow when it comes to any kind of double entry bookkeeping system. Let's go ahead further and understand what is a modern approach, what is the difference between modern approach and a traditional approach. Let's go ahead into the next sheet and we'll have more clarity on this. Now under modern approach we follow an equation. Assets equals to liabilities plus capital. Now, when we talk about asset equals to liabilities plus capital, this is the basic equation that we follow. If this equation is as per however it has been given, that means if assets total is equal to liability plus capital, your balance sheet has been tallied. However, when it comes to bookkeeping system, this is the core thing. You need to have assets total equivalent to liabilities plus capital. Only then you can have a closure of accounting systems. Now when we spoke about the equation, we need to have asset equals to liability plus capital. You need to have asset total which should be equal to liabilities plus capital. We can further break down capital as per the mentioned equation which has been given. Let's further go ahead and check that part. The further breakdown is assets equal to liability plus capital. That means capital can be further classified as these kind of categories which has been mentioned here. Plus revenue minus expenses. Now, revenue minus expenses doesn't mean anything. It actually means just one specific thing. That means a profit part. If your revenue side is more and if you subtract expenses from that, whatever left is the profit. Now, profit, as I've told you, is a part of reserves and surplus, and reserves and surplus comes under the category of capital account, which you have learned earlier. Hence, capital is further broken down into these categories. So you can have either the equation as assets equal to liability plus capital, or you can have asset equals to liability plus capital plus revenue minus expenses. You can have either of these equations for your study. Now, when we talk about any kind of these equations, the total of assets should be equal to liability plus capital. Only then you can call your balance sheet has been tallied, and that can be further provided for communication to the users. Unless and until that is not done, you cannot go ahead and publish these reports, as it will be a flaw in your reports and will not be a valid report for any kind of user to be communicated to. Let's further go ahead and understand few more details of this modern approach. Now, when we talk about classifications of modern approach, we have classified them under 5 categories: assets, liabilities, expenses, losses, and the last category will be capital. Now, when we talk about assets, liabilities, capital, revenue, and expenses, we'll further go ahead and understand each and every category in detail. Let's go ahead and check that out. Now, assets are something that is owned by a company or a firm or any kind of proprietor. For example, delivery trucks. If the company or the firm is based into delivering goods, that specific thing is an asset for the company. If the asset or probably the company is based into real estate dealers or any kind of furniture making company, any kind of garment making company, the assets that are used for production of these things, that means the plant and machinery that will be used for production of garments, plant and machinery will be called as an asset of the company. So assets will have 2 further classifications: tangible and intangible. Now, tangible asset is something that you can feel. Supposingly, if I'm holding this pen, and if this pen is an asset of the company, I'm holding this pen, I can feel that now this is the asset of my company. But if the name of the company itself is Reliance, now the copyright or the trademark or any kind of patent and trademark writing of this specific company will be an intangible asset. However, it is still an asset because it is the part of the company. It is something that the company owns, and none other company can go ahead and copy that part. Hence, it is an intangible asset. However, it is a part of asset itself. We'll further go ahead and classify liabilities now. Now, when we talk about liabilities, that is something the company owes to someone else. This has to be paid back to someone else. We have 2 different kind of liabilities: short-term liability and long-term liability. Short-term is something that has to be paid within 12 months. Long-term is something that can be paid off any point of time after 12 months. So if you have taken a loan from a bank for a short term, that means for 6 months you have to pay that thing within 6 months, that will fall under the category of short-term liability. However, if you have taken a business loan from the company or any bank or any financial institution, and this has to be paid off within 6 years or 7 years, which is more than 12 months, that will fall under the category of long-term liability. We'll further go ahead and classify capital and what are the types of it. Now, capital means an amount that is invested into a company out of its own pocket. So if I am the owner of the company and I'm investing certain amount out of my own pocket, that means I'm investing this specific amount as a part of a capital. Now, if I can withdraw that specific capital, that will be termed as drawings. Hence, when we talk about if I've invested any kind of capital, that means, let's take an example, I've invested 10 lakhs into my own company. Out of all no reasons, or probably due to any kind of specific reason, I withdraw 2 lakhs out of that specific 10 lakh, I will still have a balance of 8 lakhs capital. That means now my company will have a capital balance of 8 lakh which has been invested out of my own pocket. So capital is nothing but the amount that the owner owns and is investing into his own company. So anything that has been invested into his own company will be a part of capital. Now, capital cannot be just an owner's amount. It can be also any kind of fund that has been taken due to issue of shares, debentures, preference shares, all these things will also form a part of capital. Reserves and surplus that we have will also form a part of capital. So all these things will fall under the category of capital itself. Let's further go ahead and understand what do you mean by revenue and expenses. In a case where, for example, you have any kind of transaction whereby the cost of the asset or probably the garment cost, let's take a small example. Let's make sure that A is a fruit vendor and he sells out apples. The cost of the apple is 10 rupees. However, he sold one apple for rupees 12. Now the difference between 12 and 10, that is rupees 2, that is the profit, that is the revenue that he has earned. Now to classify this thing, there are two categories here. One, that is revenue, that means the cost at which he has sold, and the difference, that is the profit that we're talking about. So if you want to talk about revenue, the amount on which he sold that specific item or product will be termed as revenue. That means rupees 12 is the revenue that he has earned. However, if you have to term the profit, we need to mention 12 rupees minus 10. The cost of that specific apple is rupees 10 and the profit that he has earned by selling it at rupees 12 is rupees 2. So when you talk about revenue, you talk about two things. One, that is the operation activity, rupees 12 sold out, and the additional profit that he has earned, rupees 2, because the cost of that capital or probably the cost of that item was rupees 10. So when we talk about revenue, we talk about profit as well. Now when you talk about gain, gain is a non-business transaction or a non-financial transaction which is not related to your business. This is related to your business. So when you talk about selling out your operation activities, or when you talk about making out or doing the same thing that your operation activities happens with, this will be termed as revenue. Gain will be a part of non-operating activities. Just a difference to ensure. Now we talk about the last part of this chapter, that means expenses. To continue with our operational activities, we have to spend certain amounts. Let's take an example. To produce garments, we need certain plants and machineries, we need certain permissions, we need certain items, some raw materials. So the amount that we spent on these things, these are the expenses that we have made so that we can produce a specific good and we can generate income out of it. Now, the profit is the later part of it. Expenses are something which you need to understand is a part of giving out money so that the production can start, the cost of goods can be acquired or can be procured, and further that specific good can be sold out to generate income and to ensure that the profit is a part of it. Now, income and loss will be a part, it will be at later stage. That means if at all you had a break-even point, or probably you had to sell around 100 items in a day but you ended up selling only 50, so the loss that you have suffered or probably the gain you couldn't achieve is because the target was 100, however you have sold out only 50. That's when you talk about gain or loss. However, when you talk about revenue, that means the revenue that you have earned is out of selling 50 items. So you sell 50 items, you sell 100 items, no matter what, it will still be considered as revenue. And the expense is to produce those 50 items or those 100 items is the expense amount. So this is the difference between revenue and expense. So this is what we have learned about the meaning of double entry bookkeeping system, the approach that we have, the types of accounts that we have, and the process that we follow when it comes to any kind of accounting system. So that's it for the day. Thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.